Something interesting is happening in the markets. We're in the middle of earnings season, and instead of fear, we're seeing strength. Green across the board. Sentiment flipping back into greed, and investors quietly starting to position again. And in moments like this, the real opportunity usually isn't in what already ran. It's in what people are starting to notice too late. So in this video, I'm going to break down the top stocks I'm watching and interested in buying right now, based on earnings, momentum, and long-term growth potential. Let's get into it, starting with the first and most obvious one, Meta Platforms. I've already talked about this company in one of my previous videos, but in my opinion, it's still one of the best stocks you can buy today. It's currently trading a little over $600 per share. After its recent earnings report, the stock actually dropped about 10%. And in my view, that happened despite very strong underlying growth, mainly for two reasons. First, family daily active people grew only about 4% year over year, and actually slightly declined compared to the previous quarter. Meta explained this mostly by temporary issues, including internet disruptions in Iran, as well as restricted access to WhatsApp in Russia. But the bigger picture is this: they already have more than 3.5 billion family daily active people. At this scale, it becomes extremely difficult to keep growing at the same pace, because you're already talking about more than a third of the entire global population. So personally, I don't see this as a valid reason for the stock to sell off. The second main reason is their CapEx. They increased their CapEx range by about $10 billion, driven by higher component pricing and additional data center costs to support future year capacity. And that's what the market is worried about. The idea that return on investment might not be as strong in the short term. But in my view, that concern is overdone. I still think the valuation here is extremely attractive. The stock is trading at around 22 times earnings, which is actually below its historical average of around 26. And we're talking about a company that's still expected to grow revenue by more than 20%. That's what makes this setup so attractive to me. Usually companies with this level of growth, margins, and cash flow trade at much higher valuations. Meta is basically a high-quality compounder, and almost every key metric points to this being an extremely strong business. So personally, I still see the stock as a bargain at these levels. Moving on to the next stock, Microsoft. Microsoft is another company that went through a pretty significant correction recently, sitting roughly 24% below its highs. At one point, the stock had fallen as much as 36%. And honestly, that was an amazing buying opportunity. But even after recovering from those lows, the stock still looks very attractive to me here. This is still one of the highest quality businesses in the world, with dominant positions in cloud computing, enterprise software, and AI. And what really stands out to me is just how profitable this business already is. We're talking about a company with incredible margins, and despite its massive size, profitability is still gradually improving over time. Now, the improvements aren't dramatic, but honestly, that's completely normal at this scale. Once a business becomes this large, making significant jumps in profitability gets much harder. And that's also why I don't see Microsoft as the type of stock that's suddenly going to deliver 300% returns in a single year. For me, the appeal is owning an ultra-high-quality business that can continue compounding steadily over the long term. And once you start looking at the revenue growth, the investment case becomes even stronger. Microsoft has been an incredibly consistent company when it comes to revenue growth over the past decade. Over the last 10 years, the company has grown revenue at an average CAGR of around 13.3%. And honestly, that's extremely impressive when you consider the size of the business. We're already talking about one of the largest companies in the world, yet it's still growing at a double-digit pace. That's what makes Microsoft such a special business in my opinion. And what's even more important is that analysts still expect the company to continue growing at a similar pace over the next few years. For a company of this scale, I think that's absolutely incredible. And that's exactly why, even when you look at the most basic valuation metrics, the stock still appears undervalued to me. Historically, Microsoft has almost always traded at a pretty significant premium. Its average PE ratio over the past years has been around 32.5, while today it's sitting closer to 24. And what's important here is that even during the 2022 market crash, Microsoft's PE only dropped to around 23, so the valuation almost never gets much lower than these levels. And we're seeing the same story with the forward PE as well. Historically, the average forward PE has been around 29.7, compared to roughly 22 today, which is still significantly below normal levels. So even just based on market multiples alone, the stock still looks undervalued to me. And to take it one step further, I also built a full DCF model for Microsoft. Based on my assumptions, the weighted target price came out to around $490 per share. Compared to the current price of roughly $414, that implies about 18% upside. So the DCF analysis also supports the idea that the stock is currently undervalued. And honestly, this is exactly the type of setup I really like, because buying great businesses at fair prices is already good enough long term. But when you get the chance to buy them at a discount, that's where things become really interesting. In my model, the base case implies around 14% upside. The bull case gives roughly 68% upside, while the bear case suggests about 19% downside. So overall, Microsoft still looks extremely attractive to me. That being said, if I compare it to Meta, I still personally find Meta slightly more interesting with the current setup. But Microsoft is absolutely a company I'm watching very closely right now. Last but not least, Netflix. And Netflix is actually a very interesting case right now. While most of the market has been moving higher recently, semiconductors, big tech, AI-related names, Netflix has gone in the opposite direction. Over the last month alone, the stock is down around 12.5%. And honestly, that's exactly what makes this setup interesting to me. Because right now, the stock clearly doesn't have the best momentum, and sentiment around it has weakened a bit. But very often, those are the moments when the best opportunities start to appear. And that's exactly why I've been paying much closer attention to Netflix recently. Now, when it comes to valuation, Netflix has historically never really been a cheap business. Over the last 4 years, the company's average PE ratio has been around 39.5, while today it's closer to 28.5. And the same thing applies to the forward PE. Historically, the average forward multiple has been around 32, compared to roughly 26.5 today. Now, you might be wondering why there's such a small difference between the current PE and the forward PE. And the reason is that EPS was temporarily boosted by a one-time gain related to the Warner Brothers deal that didn't end up happening. Netflix received around $2.8 billion from that situation, which had a significant impact on quarterly earnings and made the current PE look cheaper than it normally would on paper. But even if you focus on the forward valuation instead, the stock still doesn't look particularly expensive to me, especially considering the quality of the business. Because Netflix is still not a fully mature company, the business is still improving, and you can clearly see that in the margins. Gross, operating, net, and free cash flow margin are all consistently moving up and to the right. And that's exactly what you want to see as an investor. It tells you that the overall quality of the business is improving over time. On top of that, Netflix also has an extremely high return on invested capital. For 2025, ROAC came in at around 27.6%, which is honestly very impressive. So to me, this business still has plenty of room to grow, and that's what makes the setup so interesting. Even though revenue growth expectations over the next few years aren't extremely high, I still believe Netflix can deliver very strong returns for investors. And now let me show you why I think that. So to take it one step further, I also ran a full sensitivity analysis for Netflix. And as we already discussed, revenue assumptions are not extremely high, but I'm also not expecting anything unrealistic here. So in my model, I'm using around 9% revenue growth in the bear case, 10.5% in the base case, and 12% in the bull case. And to me, that feels pretty reasonable for a business like Netflix at this stage. Now, when it comes to profitability, the business has been consistently improving over time. So I'm assuming a net margin range of 32% to 36% in year 5, which I think is fair given the ongoing expansion in margins. On top of that, Netflix also has an active buyback program. So I'm factoring in share count reduction of about -1% in the bear case, -1.5% in the base case, and -2% in the bull case. All of this translates into EPS growth of roughly 13.3%, 16.8%, and 20.4% depending on the scenario, which is already very solid. Now, for valuation, I assume a PE range of 26 in the bear case, 28 in the base case, and 30 in the bull case, and I think that's fair given the quality of the business. I also use a required return of 15% as usual. And when you put everything together, it gives me a fair value range of around $94.36 per share, compared to the current price of a little over 88. But if I apply a 10% margin of safety, which I usually do, that brings my entry target down to around $84.93 per share. So basically, around $85. And that's why, for now, I haven't added to my position yet. But I'm closely watching it, and if the price gets closer to that level, I would definitely consider increasing my exposure. Overall, I still think Netflix is a very strong investment idea right now. So to wrap everything up, in today's market environment, Meta is my #1 pick, by a clear margin. For me personally, it stands out the most in terms of setup, valuation, and overall risk-reward right now. Microsoft and Netflix are also very interesting companies, and I definitely like both of them at these levels. Of course, there are many other strong companies out there as well. This is just what I'm personally watching right now. So I'm curious, what stocks are you currently following? Let me know in the comments what you think is interesting in this market. And if you enjoyed the video, make sure to leave a like and subscribe for more content like this. I'll see you in the next one.